It's go, 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 go time.
Welcome to the Next Level Mortgaging Podcast. My name is Todd Martin, your host of Mission 35 Mortgages. Today we have Kerri, Vane, and Sean Wilkinson from MNP, from the Charting Accountant people. These people are fantastic. They know their stuff when it comes to your taxes. They're fantastic. These guys know your information. We're going to talk about the new capital gains rules that came into effect this year. I know there are so many questions about this stuff. So many, there's a lot of confusion out there about this kind of stuff, about what the new rules are, how they work, and how they affect you. So we're going to try to get into this a little bit today, dig in a little bit, get some questions answered, and try to unravel some stuff for you. Sean, Kerri, thank you so much for coming on and trying to unravel this a little bit for us.
Thanks so much for having us, Todd. Really appreciate it.
Yeah.
Thanks for having us. Yeah.
So, I mean, obviously, the first question is, what's changed? How's it changed? How does it affect just the average person selling their house? They've had it for, 5 or 6 years. The house has gone up in value. However, the house has gone up in value a couple $100,000. Or, as opposed to somebody that's, my parents that have owned their house for 30 years, right? They bought it for 200,000 and now it's worth $1 million.
Right. So let me speak to that piece first. If it's your primary residence and that's the property you own and it's gone up in value, that's your principal residence. And that's one of the best tax benefits we have in Canada is our principal residence exemption. So if you've lived in it and it's your primary residence, you do have to report it when you sell that property on your tax return, but it is not taxable. So that we'll start there with whether these changes are in effect or not. Whatever happened, we still have our principal residence exemption. So that's good, right?
That's an easy one, right?
That's
so
an easy. I took the easy
for everybody. Because your principal residence, you are exempt from it.
Yes.
So you go on from that, beyond that. So we have a lot of people out there in my industry that are into investment properties. They have 2, 3. I have a friend of mine that I'm a partner with that's going into purchase who has 5 investment properties, right? He's going to start looking at revolving them now, right? Because he's had them for a period of time. He's had them for 5 years. So he's bought the first one, say, for $400,000. It's worth $800,000 now. What happens there? How does that work now?
Yeah, I can talk about that. So at first, I'll just go into kind of a short kind of summary of what the technically they are still proposed changes. I just want to kind of preface that this legislation has not yet received royal assent. So although they came into effect in June 25th of 2024, this year, technically it hasn't passed into law. However, all accountants and everyone right now has to be treating it as such, that it is law, but there is a small chance and a possibility, given the kind of disruptions in Parliament right now, that something happens with this legislation. Our advice to everyone out there is to operate as if it is law, but take it with a grain of salt, because there's a possibility that this doesn't actually come into effect, and the bill could be killed if a new election is triggered and the new government decides to go a different way, or a possible new government.
Interesting nugget.
Yeah, this is the world we've been operating in, all this like fun unknown stuff.
Yeah.
Operate as if, but never know what's going to happen.
Right.
Exactly. So a quick summary of what the new rules are that came into effect on June 25th. So originally, when you had a capital gain, you sold capital property, 50% of it or 1/2 would be a taxable inclusion. Now that rate has changed from 1/2 to 2/3, so about 66%. A caveat to that is that for individuals, there's a $250,000 exemption to that. So your first $250,000 are still going to be using that 50% effective rate. However, anything above the 250 is now subject to the 2/3 inclusion rate. Corporations and trusts excluding graduated rated trusts. So someone who passes away, they're going to get that $250,000 exemption on any capital gains, but any other type of trust and a corporation do not have access to this same $250,000 exemption. So I think that's probably going to be the crux of our discussion today.
Yeah. So that means, so like, it almost takes out the advantage of, you know, somebody doing the multiple home ownership and landlords running multiple rentals to creating a holdco or a corporation to run those businesses out of. There's no longer a tax advantage to do that at that point, because you're losing out that $250,000 exemption at that point. You're almost better to run it individually off your own personal property, off your own income at that point.
So yes and no, right?
Yeah.
There's still a
As
lot of
usual.
reasons why you would want to hold your property in a corporation. I mean, to start off with, if you have your holdco that was generated from operating company income, that money is in your holdco, and you know, to pull that money out of your holdco and then invest it in a property is going to cost you a lot of money. So in that situation, it makes sense to just keep that investment in that corporation. Who knows what will happen to capital gains inclusion rates down the line, right? And there's other reasons why you'd still want to keep it in a corporation, like asset protection, like estate planning, right? The tax advantage itself is, and even the concept of a tax deferral is kind of off the table now, right? That's kind
Agreed.
of yeah. And Sean can speak further to other reasons why you still really would want to keep it still in a corporation, right? That it's that liability piece that's key, especially if you have a high risk property. Like even commercial properties can be a higher risk, right? If you own a bar, a restaurant, like maybe you want to keep that in a corporation. Yeah.
Yes. So
Mhm.
yeah, sorry,
Yeah.
go ahead, Todd.
I was going to say, so like an example, you have a property sold, you know, bought out, say in the 90s, $250,000 in Hamilton. We know how much downtown Hamilton properties have progressed in the last 20 years, right? So how much that, especially in the way there's no space in downtown Hamilton now, right? So you put in, say, $100,000 into it to renovate it and add a little bit to it in that period of time, but now it's worth $1.5 million.
Yeah.
Right, because of the value of the space. They're looking at developers now, right? Developers properties, because everybody's looking to go up now in Hamilton instead of, you know, purchasing for the space, instead of purchasing the existing property and using it for existing office space. So at that point, if I know what I'm talking about, if I know what I've read, they can take off the purchase price, they can take off the money they put into the property. Yep. Correct. And at that point, you are stuck paying the 66% on what you make above and beyond.
So Todd, I actually did.
Yeah.
Sorry, go ahead. I did.
No, you can clarify that 66%. Like that's not the tax rate, right? So I'll let Sean kind of explain.
Yeah, it's the inclusion rate. So Todd, I actually did kind of an example very close to kind of what you were discussing there. I don't know if you want me to kind of
show it. Let's see it.
Yeah. I'll pull that up. And it's just kind of a walkthrough of a comparison of if I have $1 million property that I bought myself, held it personally, versus I had $1 million sitting in a corporation, right? And I decided to purchase it that way. So here's kind of the what's going on. A person, they originally bought it for $750,000 and with their own individual money, or they use $750,000 inside a corporation. They're deciding to sell it today, being after the capital gains rate inclusion rate change for $1 million. So I crafted this example, obviously, so we came up with the $250,000 gain, which is the difference in the personal exemption. Anything in excess of this, so if we sold it for $1.1 million, then your tax from a corporate perspective versus your tax from a personal
Right.
perspective is going to be the same on any incremental amount above that. But the first 250 is where we're going to see this
You see the
difference.
difference, right?
So the way an inclusion rate works is we take our gain, which was just 250,000 in either scenario. For personal, it's going to be using our exemption. So it's going to be at 50%. We times this number by 50. We're left with $125,000. That's the amount we're going to have to pay tax on. Individually, as a corporation, it's 2/3. We're paying tax on 166,666,000. So there's the difference in the taxable amounts.
Oh, I get it now.
Yeah.
Okay.
When we apply tax to that number,
That makes more sense.
it's going to be about 83,000 inside a corporation, personal 67,000, which brings us to an effective tax rate for an individual of about 26.76%, for a corporation 33.45. So
That's not quite as scary as everybody thinks it is then.
Yes, that's
Yeah.
what I wanted to clarify.
Don't get me
that.
wrong,
Yeah.
it's not a great number. It's still not a
No.
great number.
no,
Right? But it's not the 66% rate that everybody thinks they're going to be paying.
Right.
No.
Which
They're
is
paying
why,
tax on 66%. They're paying the tax on the 66% of whatever
that.
gains they're making.
Which
That
is
makes
why it
things a
needs-
little bit
yeah.
clearer. Oh,
Which is
that
why
makes
it
it better.
needs
I
to
like
be-
that. I appreciate that.
yeah, which is
Yeah.
why you really have to weigh the other benefits you could have of having that property in the corporation. There's other reasons why you would want to do
Absolutely.
that, right? And that's why the cost is, this is that cost, and it could still perfectly make sense to have those assets in a corp.
100% it does.
Yeah.
Absolutely, for sure.
Yeah.
and kind of our magic number there is 6.7%. That's the additional tax that you're paying
Cost.
inside a corporation versus if you held it yourself. Now,
Right. And for what you're going to save for keeping it in there, for keeping your money there is, and keeping it protected and safe, right?
Yeah.
From
So
personal
it's-
protection and all
it's-
is well worth that investment, I would think.
it's always going to depend on individual situations.
You're right.
Someone
Absolutely.
who's sitting on a ton of money inside of a corporation today, as Kerri mentioned, it doesn't make sense to pay that tax to get it out just to get your $250,000 exemption, which is really only worth maybe $20,000.
Yeah.
Where you're going to
exactly.
pay a lot more tax to extract that funds from a corporation. But
Especially if you have an existing corporation already, right?
Exactly. Yeah.
If you're looking at starting a corporation now to do that, then you
Yeah.
can look at whether it's worth the cost at that point in time. But you have something there, you have the money there already. What is it worth taking the money out at that point in time?
Yeah. Some kind of other things outside of tax that we kind of wanted to bring up that are potentially advantageous to having a corporation versus investing personally. Kerri already mentioned the limited liability of a corporation. If you have assets inside a corporation, any lawsuit or liability that you have is limited to the assets inside the corporation. So if we're talking about a real estate investor, obviously they can go after the real estate that's there, but they can't go after your personal house or your car or something like that. Obviously, there's other types of insurance that can prevent that, but the corporation kind of offers an additional kind of level of insurance. There's estate planning opportunities where we can kind of freeze the value of a corporation past the future growth on over to the next generation. That's obviously something that's not available as an individual. We were thinking it depends on scale here too. If you're talking about someone that's got 1 or 2 rental properties, that $250,000 exemption could be a big deal to them. If you're talking about someone that's investing $40 million in real estate, it's going to have massive gains, that exemption is probably not as valuable to them.
Right.
And they're probably going to be looking to the other potential benefits of using a corporation. We were also thinking people that invest in real estate groups that have partners or it could be 10, 15 people, depending on how big it is. A corporation can be used kind of more as an administrative tool, kind of to manage where the money is, how tax is paid. If everyone's reporting their gains from a bunch of rental properties that are split amongst a large group, it can get very complex when you're dealing with it all kind of personally.
Oh yeah, 100%.
Yeah.
This is really informative. I really like this. This is great. You laid this out perfect. This answers so many questions that just have been asked to me that, I'm relatively new to mortgages in the financial world, and I do my best to try to follow so many rules, so many changes that come in just in the, less than 2 years that I've been in this business. And, you can get dizzy trying to follow the rules that change on a daily basis, right? And the policies that might be happening, might not be happening, are happening, did happen, didn't happen, got changed, moved over this way or over there, and you're like, wait, what? Who? And I thought I had my head wrapped around this. And you know what?
Sorry.
I'm pretty sure I had this figured out when it first came out, the way you explained it. And then 15 other people got in my head about other stuff on how to do it. And I'm like, wait, what? No, huh? And then as soon as you explained it, I was like, that's right. I knew that. I knew that's how that worked. Why wasn't I thinking that the other way? And because we hear so many things from so many different people and so many outlets out there, and so many people are out there spreading bad information on how things work, right? And so many people are screaming from the mountaintop saying, this is what's happening. You have to stop it. And I when it first happened, I'm like, you guys got to stop and take a breath and really read what's out there. Right.
Or,
and then
reach out to
I
a
lost my
professional.
message.
Yeah,
Right?
reach out to a professional. Like if I had $1 for every time I've been out and somebody, or sorry, I've talked to a client and they've said, hey, I was at a party and the person I partied with said that I could do this, this, and this. And you're like, well, no, right? So you have to really come back to the trust you have with your professional accountant, lawyer, financial advisor, and
This
and
is
really know the
exactly why I
benefit,
reach
the
out to
value.
people, right? Like,
Yeah.
I know mortgages. I know
Yeah.
and I learn every day. This is something new. I write down, I throw it in a jar. Something new I learned every day about a mortgage, right?
Yes.
And it's a
Yeah.
very full jar. And and that's when I had that question come up, I said, you know what? I have some good accountants, but I want to reach out to somebody that might know more about this specifically. So I reached out to Oliver at Scotiabank, and I said, give me somebody I can talk to that might know this better, right? I know you guys know people. You guys know everybody, right? And that connected me with Kerri, and that got me to Sean. And I'm like, this is the stuff I need to know. These are the people I need to know, right? Because they can answer those questions.
Yes. Oliver's great.
Right?
Yeah.
Guys, I really appreciate this. This has been fantastic. You really clarified a lot of information for me. This has been, and I can share this. Awesome. Thank you so much, guys. I really appreciate it. Enjoy your week. Enjoy your weekend. Try to have a break. I'm going to probably not have one.
No, that's a good thing. It means it's busy.
Yes, it is. All right. Thanks, guys. Have a great day.
Thanks.
Thanks for having us, Todd. Very nice to meet you.
Yes, thank you for having us.